Welcome back. What will the RBI do? That is the predominant question that has been on the market's mind, both the equity and the fixed income markets. The rupee market have their own story to tell, obviously, because of all the rhetoric, quote-unquote, sort of commentary we've heard from President Trump over the weekend. But, of course, we have Latha joining in. She was sitting down with a bunch of experts for the CNBC-TV18 Citizens Monetary Policy Committee meeting. So, Latha, what is the takeaway? Any cut, any softness, any more liquidity or help?
Yes, sir. It's a mock MPC, I would like to think, and it's fairly representative of the market's opinion and the expert opinion. There are quite a few people who are not trading a book, so, it's an academic opinion as well. Now, the key takeaway, a pause on rate hikes. So they're not expecting a pause on rate cuts. You won't get any action except for 1%. So 4:1. No change in rates. Sonal Verma was the one who dissented. She was voting for a cut even in October. On CRR, the majority expect a tinkering of the CRR. 3:2 majority. The others also say that liquidity will be provided, but only by other means. Like, the RBI can buy bonds or they can use the VRR, the repo rate, variable repo rate. But they are all expecting liquidity to be provided. All of them expect a rate cut by February. All except one, the one person who's already expecting it in December. So it's only a question of waiting for 2 months. All of them expect inflation to be marked up. One number I got was 4.8, but the average I got from the street also is around 4.8. All expect growth to be marked down. I didn't take a poll there, but the poll that I did take said that it would come down to 6.3. The growth, but 6.5 is where the RBI may itself put it. The street expectations are more like 6.3. RBI probably will bring it down to 6.5. Now, I'll tell you the main reason, which is very convincing. At a time when liquidity is not adequate, even if you give a rate cut, banks can't pass it on. They will pass it on to that external benchmark linked products like home loan and corporate loan. But for a better part, auto loans and all, they will not, because they're still borrowing. Their raw material is expensive, deposits. So they will not pass it on. But the other way around, if you do a CRR cut, every time I give a loan, I actually make a deposit in your favor. And then I have to keep, instead of 4.5, if I keep only 4% idle, then that extra money, I give it to you in your cost. So when you do a liquidity injection, immediately, the products gets cheaper. So their point is that if you want to drive credit growth or fuel the economy, this is the easier thing to do. It's very difficult when your last number was 6.2. It's not even that. You can argue that as the lagged number. But you have to increase the inflation forecast. How can you increase inflation forecast and say I'm cutting rates? So they expect it to be tough now, but easier in February. But let me tell you, there is still a niggling worry in the market, not in my MPC, that a repo rate cut can come.
Because things are looking a little more dire than...
who knows February what will happen? Maybe the Fed will stop cutting so that you will be faced with a more hawkish environment. So why are you assuming that it will be easier in February?
Why niggling worry though, Latha? I thought niggling...
People will be happy.
Positive, okay. Worry because you're not priced for it. Okay, sorry, wrong word. A niggling hope.
Considering, I was just looking at today's developments in China, considering our neighbors, now the bond yield has come down to less than 2%, China. And with all this tariff hawkishness and action, and God knows what's upon us come January. And like you said, we don't know what the Fed will ultimately do. Perhaps will the RBI suddenly have a change of heart?
I mean, but China, Surabhi, for the longest time, yields have been sinking lower and lower because there's deflation. I mean, outright deflation.
But they are
and also they're not investing in the equity markets. Everybody's running to some sort of a perceived safe haven, buying bonds. And that's just
okay. So just quickly, what they key sentence from each of them. Soumya Kanti Ghosh of SBI said rate cut won't get passed on, and that is why it won't be done when liquidity is tight. He expects a 50 bips in February. Cut late but big. Samiran Chakrabarti says Q2 was too bad. We must not extrapolate it completely. The base effect of very high EBITDA margins for mining and metal companies vanishes in the third quarter. The base effect is not bad. So actually growth could look better. But the worry is like the pressure is there on the rupee. So they can't do much. Sajid was the one who was really worried. I mean, the global scenario is likely to be so confusing lower growth, probably higher inflation, probably even deflation. If China dumps because it can't sell in one country.
Yeah.
So it's a very confusing scene. Sonal Verma's point that inflation is seen closer to 4 next year. So you don't have to look at this. Yes, I am increasing the forecast for FY25, but I am decreasing it for FY26 can be a reason enough. And finally, Dr. Pranab Sen saying that why are we alarmed? Growth has come back to its pre-COVID level. Our natural rate of growth is 6.5. If you thought it is 8, that's your problem.
8 sounds so much better than 6, right? Latha, thank you so much for that. Very quickly before the market closes, let's try and get it.